why and how economic crisis happen and what to do about it. Hi, it's CFD over here, and today I want to talk about this very topic, how and why economic crisis happen and what to do about it. So as someone who have lost like 50% of my stocks holdings back in 2008 economic crisis, and at the same time I've gone through the experience of making 100% from trading options, in 2008, 2009, and as someone who have made hundreds % from my stocks holdings over the years, I think nothing really can surprise me when I see stocks like drop 5% or 10% in a day. Now, so you know that I've been to both ends of the spectrum where I lose a lot of money, and you call that as a tuition fees, and the other end of the spectrum whereby I make hundreds % over a span of a week or a month. So I understand really what you are going through, right? If you now see your investment has been like going down, going underwater, losing like half of your investment, and it also makes me someone who are credible to talk about this topic in year 2020. Aside from the fact I'm an independent financial advisor, which I'm managing clients' investment as well. And I'm filming this just to, really to give you an honest, no holds bar, straight from the hip kind of sharing, because in 2020 I've seen so many fake gurus and financial bloggers who had probably never gone through recession or economic crisis before and never had their money invested, never lose a single cent from their investment, and then now they're coming out to try to tell people like this could be the biggest opportunity of our lifetime, right? So you must invest. Now, by the way, as I say, as an independent financial advisor who's been advising mostly like T20 clients, I probably possess that unique edge into seeing how a lot of successful people think and what they do with their money and finances. So as I'm advising them, I'm also learning from them. These are the things that are not really a lunch or dinner table conversation. Things like a successful relative, friend, colleague, or even ex-classmate that you probably admire, but when you ask them, they never really want to tell you what they do. But I'm sharing that a lot of those tips in this channel. So, and also unlike many financial agents out there claiming to be an advisor, but really they are just like pushy, sleazy salesperson or salesman. For me, I'm probably the worst salesperson you can find, but really I possess the heart of a teacher, and I'm doing this because I really want to leave a legacy. Therefore, I published a lesson in this channel, CFD channel, that could help you to make the most out of your career, business, or money, or in life. Not worry about money, be in control of your money, outdo your peers, not wait 20 years to see a result, and get actionable information for your personal situation. In fact, in this CFU channel, these are what other people are saying, these are what my YouTube subscribers are saying, so you definitely don't want to miss out, and the way to do that, not to miss out on the lessons that I'm going to publish, or the existing lessons, hundreds over that is already in this channel, hit on the red subscribe button on the lower right hand corner, turn on the notification bell as well while you're at it, so you get notified when I publish no BS lessons like this. Now that being said, let's jump right in, how and why economic crisis happen and what you can do about it. Now for that, we have to actually take two case studies, one, the economic crisis in 2008, and then another economic crisis in year 2020. So why did the 2008 economic crisis happen? One word, subprime mortgage in United States. I'll explain in a simplified manner, so bear with me, how this subprime mortgage crisis happened and what leads to it. So you know that banks are in the main business of lending money to other businesses or to individuals, and anyone that take money from the bank becomes the bank's asset. And then you're expected to repay banks in a progressive kind of installment over the years. So when you did not pay the installment, banks actually lose their so-called income, in the form of your monthly payments. And also, if you default on the entire loan, so bank basically lose that chunk of assets because they cannot recoup that amount that is being owed to them, what we call the outstanding loan. Now, to really do this business of lending money, banks need to do due diligence. Now, how banks actually do due diligence or background checking, they have to really find out whether you're a good paymaster or not, and whether you can afford the monthly repayment or installment based on your income or business revenue. So very easily, the other way to put this, to simplify it, is they check your credit rating and your payslip or your business revenue. But back then in the US in 2008, they are more chin chai, right? Even if you have like bad credit rating, you have a really bad repayment history, or you have like insufficient income level to take on the loans, the banks will also approve your loans anyway, because they want business. And banks earns interest on the loans they gave you, plus they have whether your car, whether your house as an asset, which is what we call as collateralized loan. Now I'm not talking about credit cards and personal loan. Now obviously that does not come with a collateral, which explains why the interest rate on those unsecured lending is like 3 times or 4 times higher than these loans that come with a collateral, like your house loan or your car loan. Now this pure capitalism, right? It's a win-win scenario. But then after that, banks actually get very creative. They say that, can we actually make more money out of what we're already doing? So what they do in the US back then in 2008 is that they try to package all these mortgages, all these loans, right? Especially those loans, we're talking about mortgages and loans that come with a property as a collateral, into an investment called mortgage-backed securities, or MBS. And then they actually sell these mortgage-backed securities as an investment to, to everyone, including institutional investors like big pension funds, insurance company. And then at that time they say, yeah, this investment, they come with this collateral, which is property, and that brick and mortar property are always safe, are always secure, right? Very safe, very safe. But then somebody must have woken up, and it comes with a sliver of rationality. Some very smart guy started to question, like, the initial assumption made on the values of these real estate properties, which is the underlying asset of these mortgage-backed securities. They say that, why does this deserve such a high valuation? And then they start to spark the idea, right, to say, hey, why, right? There is an oversupply of real estate property in the US. Why are those properties still valued so high, right? When you have oversupply, your price actually, or the valuation actually goes down. So this is like a very basic law of supply and demand. Then they say, well, is everyone out of their mind? Like, everyone is shocked, right? Everyone crazy, like totally ridiculous. And then other people who actually look at this kind of insight of perspective, they also woke up. They say,
right? Like, why is it valued so high? No, it doesn't justify the kind of high valuation for the real estate property back in 2008 in the United States.
And then now this whole sentiment turns like 180 degrees, right? So housing price or value goes into correction. Now that means that they start to drop. Now this kind of trend actually snowball, and then there is suddenly a big shift in the sentiment. And this thing gets amplified into the news. And then, when things get worse, it spreads across the world, because US is considered as the bellwether of the world economy. Now, of course, China is catching up as the number 2 world economy. Probably they will overtake US very soon. Now, you know that as the biggest economy in the world, the top 3 guys, when they sneeze, the entire world feels the impact. Now, this sentiment is really contagious. You can really call that a herd mentality, as contagious as coronavirus. And it's the same, just like, people who actually hoard and buy these toilet papers and gardenia bread. And if I were to ask you, like, say, hey, why you buy so many toilet paper, right? And then you tell me,
I don't know, I see people buy, I also buy abuden.
And then they say, why? You say, no specific reason, just a very kiasu mentality. And it's also the same, like people who speculate on property investment, who don't know those property flipper. Now with this recession coming, they realize that what the property guru tell them, to say that after 3 years you bought it, you can actually flip that and earn a handsome capital gain. Well, that dream really get crushed now. And there's a so-called a panic selling, but when it comes to property, you know that it's not so easy to sell. When it comes to stock market, that asset class is actually more liquid, so there's these are panic selling. So panic selling, people are selling right now. Even business owner, bosses who think that the value of property are very sustainable in the long term. In good times, they buy a lot of property, and then they thought when times are bad, when the business are not running for 1 month due to a business lockdown, and then they say that I could turn that property, into a cash, and then they realize that during lockdown, no real estate agent are actually working. You want to sell, it cannot be easily liquidated, so you have a white elephant sitting there, you have a property value of 2 million or 10 million, but the thing is you cannot turn that into cash. So it really boggles me to say that why does people, though some business owner thought they are very smart, but then they really don't realize that property, when you really want to sell it, you're probably not able to sell it, or not able to sell it at a profit or at a price that you want. So you see, really, when this kind of panic selling happen, obviously, when you see people are doing this, you also get kanjiong, get nervous already. You don't want to miss out, right? Because if let's look at this way. If everyone is actually having the very same thing you had, right, an investment or property or whatnot, if they are actually selling that, do you really want to be the fool who sell the last? No, right? You don't want to be the last person to actually sell it. Now, before this actually get very serious, where there's a mass panic selling of real estate property in Malaysia, right? You do not want to be the last one to sell. So you really have to evaluate whether, if your properties are already, gain some profits over the years, and then even though it's still, being rented out, but then you really want to evaluate whether you want to still keep this property still, or really want to actually let that go before this gets serious. So I want to ask you this very question. Are you unsure how much longer you should hold onto your worst performing real estate investment property, or whether you'll be better off selling it as soon as possible? You get tired of attending property investment seminar by property gurus who are still trying to convince you property investment is still as easy and profitable as 5 years or 10 years ago. Well, they might be right, or they might have their own agenda for saying so. Want a non-biased second opinion? I'm conducting an online web class this week to answer this burning question. You are also going to discover if your property is at risk of not able to increase your tenant's rental in the future. If you feel you are going to benefit from these out of the box insider insights, click on the link in the description below after you finish watching this video, and it will bring you to a page that looks like this. No credit card required, but availability is limited. We get filled very fast. Seats are reserved on a first come first serve basis. Okay, now coming back to this, we were talking about real estate property in US, which is getting devalued dramatically back in 2008. That is what is causing, that's one of the spark that triggers the subprime mortgage crisis, which ultimately leads to economic recession around the world. It's when people finally woke up and realized how overpriced are the investment asset, or in this case the properties, the real estate property in US, and they say it doesn't make sense, right? Where you know that, remember, the underlying value of this mortgage-backed security is tied to the value of the real estate property. So when the prices are down, of course, whether good companies, good investment-backed investment, the prices will be down, will plunge. So when the price plunge for some investment that still give very good dividends, this probably would be the good time to actually buy into that, assuming that, I mean, if you still have money to invest, because that means that dividend yield will be super high. And if you want to learn about, you know, what are the best, you know, dividend yield kind of methodology or even investment, you know, in Malaysia and whatnot, so check out what is popping up on the upper right hand corner after this video ends. So you know what is really worse than, you know, losing a 10, 20%, 30% out of your investment? Worst case scenario is even worse than this, when you use leverage or leverage to invest. In other words, you actually borrow money to invest. Now, you see, borrowing money to invest works fine if, let's say, you borrow money and you're paying a 1% interest per year on your borrow money, but then you get a 5% return consistently out of your borrow money. So, you know that you actually earn 4%. But then when the value of your investment suddenly drops like rapidly, like 50%, you get a margin call. Your broker will force sell your investment. You not only lose 10, 20, 30%, basically you lose your entire capital, because the stockbroker, the person that lends you the money, need to force sell whatever is left of your investment value. In most of the time it's stocks investment, because now your stockbroker need to cover for the loan that you took from them. Now imagine this happens to banks, like in large scale, when there's millions, hundreds of millions or billions of money are involved, and banks or even those insurance company, big pension funds have exposure in this mortgage-backed security, which the price just dropped like diarrhea, like lao sai. And you know that this, especially insurance company and banking sector, this is the very core of the financial system where most of the money are circulating. So when these guys get into deep shit, you know that the shit will hit the fan. In other words, banks lose lots of money. They call that impaired asset, which then leads to this term called credit crunch. It means banks have less money to lend out because their survival is at stake due to impaired asset valuation. How? Well, banks actually, like I say, banks actually make money by lending out the money that they have in the form of, you know, mortgage loan, you know, car loan or business loan, and they generate extra revenue. They make revenue by earning interest out of the loan that they lend. And then they reinvest whatever revenue that they collected, what we call like their interest revenue, to generate more returns. And then the returns, as it grows, is being lent out again to anyone who need that with a good credit rating. And then the cycle just goes on. So what if the banking sector have less money to lend out? This is what we call the credit crunch, right? They lend out less, and then because of that, they generate less revenue from the loan interest. And then that is like someone choking on air, or someone really like strangling you, like you cannot breathe, right? Or your lungs are actually damaged because you need a ventilator to help you breathe. Now, oversight like this happened back in 2008 because there isn't adequate regulations to ensure that the banks, where they are some of the pillar of the financial system, from using too much leverage. No one actually prevent banks from doing high-risk investment. After all, you know, everyone working in the banking sector, investment banking, all that, they are chasing to meet their KPI, key performance indicator. Now, to get that big fat bonuses, you know, all the bankers, which is tied to how much money they actually make for the organization. That's just the usual corporate drill. Up until this 2008 economic crisis boils over, caused by subprime mortgage, many years in the making. Like they say, Rome is not built in a day. It's like a bottle-up emotion. And you find that banks' assets suddenly, you know, evaporated into thin air, which is now, after the 2008 economic crisis, stability and sustainability KPI for banks, like, you know, capital adequacy ratio, CAR, and for banking sector, and then for insurance, Akafu sector, when there's a lot of money inside there as well. Now, it's so important as a part of compliance. That's where the big money are being circulated. So, after 2008 economic crisis, you know that measures are in place to prevent the catastrophic collapse of the brain and heart of the financial system, which is, you know, the brain is the central bank because they control the, you know, fiscal and the monetary policy like interest rate and all that. But the actual banks are the entity which pumps blood into the system. You know, you die when you don't have blood. So now you have a bird's eye view of the entire banking system in 2008 and how the economic crisis happened and why does the economic crisis happen. So it's caused by its internal oversight. It basically is a weakness which is inside the financial system, which people take advantage on, capitalize on. So this is a term called is endogenous in nature. it comes from within, inside the system itself. Basically, the participant inside the system push it too far. It's like global warming who could actually kill us in the year 2099. We are the one who caused it, but yet we ignore it and keep on like, nothing to see, move on, business as usual, despite the many obvious signs, the many obvious warning signs. But in year 2020, where you see the signs, like stock market are down, business are actually slowing down or even go bust, and then the jobs are lost, unemployment. On the surface, the signs seems like what happened is a repeat of 2008 recession. However, when you see beyond that layer, it's actually not caused by people, human investor or speculators, taking advantage of or abusing the inherent weakness in the financial system. Well, I mean, supposedly you can say that it's still caused by humans eating bats, but this economic crisis in 2020 are caused by something entirely outside of the financial system, which they call it something which is exogenous in nature. It's like in the movie Armageddon, right? Suddenly they discover there's an asteroid coming, to Earth, which is going to wipe out the entire human race. The entire Earth is going to blow up, just like, the thing what actually killed dinosaurs millions of years ago. So there's really nobody can really plan for that kind of, a plan to actually mitigate the risk or avoid it at all. In fact, it's not even an economic crisis by itself. It's a health crisis which then leads to an economic crisis. But the powerful thing about this economic crisis or about this health crisis is such a silent stealth killer that it's as an indirect reaction to that, human race are calling it all quits, like stop all economic activity, whether it's travel, tourism, aviation, retail. So understand that now the financial system and the banks are in a way better off position. They are in a less risky situation compared to 2008. Plus the fact that regulators like the Bank Negara in Malaysia or the Fed in the US, they are more informed, they are more powerful. If you've got a chink in the armor, an Achilles heel, a weakness in the financial system, they're going to impose measures to actually fix that. And the fact is, banks now have money to lend, but because they are highly regulated, they still need to follow a strict rules to lend money to people or business that are financially strong and proven to actually be able to pay back that loan. And honestly, when banks are kiasi, then who are the ones who are not kiasi, now? Well, people who, hedge fund, sovereign wealth funds, or venture capitalists, private equities, like SoftBank, who can really throw big money, who can really bet on startup like Uber, or even when it's not profitable, even during the IPO, or maybe, company like WeWork, which failed to IPO and now are scaling down, the founders are being kicked out, and soft banks have their stocks plunged to, due to bad deals like this. Now, these are the guys that still are not regulated and they can take huge money bets. Anyway, I digress, but the point is easy money or credit is still around, but it will not be given up by banks, which are again strictly regulated now on what they are allowed to do or who they are allowed to lend their money, and what they are not allowed to do by the regulator in each respective country, because it's a hard lesson learned from the 2008 economic crisis. Now, the irony in the economic crisis in the year 2020 is that banks have the money to lend. They are more willing to lend money to you. The problem now is due to the stoppage in all economic activities, business suddenly have their retained cash or cash flow running low because they still need to pay things like staff salary and fixed costs like your point of sale system and rents, but they have no income coming in during this period. And business goes into cash crunch. Like I say, banks have lots of money to lend, but business suddenly become extremely financially unstable in the eyes of the banks. Now, to get the economic engine running again, business need to be selling again, and really consumer and people needs to be buying again, whether it's a product or services. To enable all these, there's one variable, and that is money. In other words, you can also call that as a liquidity. So it's just a very simple equation, because when you have less economic activities, it translates into less future earnings for all businesses, whether they are public, listed, or privately held. And then as a result of that, you have lower stock price, because the price almost almost always reflects the value of the company. If the value of the company is determined by how much revenue they generate, if it's getting better, then the price that the market is willing to pay for this business naturally goes higher, and vice versa. Get it? Which is why you see that the president of the United States, Donald Trump, initially mentioned that American is going back to work, by mid of April to keep the economy roaring again. But then after that, he backtracked on what he said earlier March. Now, and it's not surprising, but really coming from Donald Trump, it's really rare given his huge ego and arrogance. But with this lockdown or restricted movement order, whatever you want to call it, it's just a prudent thing to do to stop all economic activity for all this social distancing for the sake of the population health and survival and safety. But at the same time, you introduce another systemic risk, which is economic downturn or economic crisis. But if you avoid economic crisis by encouraging people to go about their normal life, as normal, you actually heighten the risk of a public health crisis, which will actually balloon up until the healthcare system are not able to support it anymore, just like what happened in Italy back in March 2020. So really, all these are really not in his favor for Donald Trump, because 2020 is the re-election year. So it's interesting to see different leaders in different countries actually take different approach to this conundrum. Some countries are actually more willing to sacrifice economic stability for the sake of the public health, where some countries are willing to risk a health crisis for the sake of short-term economic stability, like the US. So I think, given all this, whatever, our Prime Minister of Malaysia did back in March, it's actually not too bad, because he's prioritizing safety over economic factors. The other country will actually take a different approach to solve this, is by taking you out and shooting you. Well, I guess that's another way to solve this as well. Now, this is why Malaysian government also want to give most people in the M40 and B40 category give you more money to spend by allowing you to withdraw EPF money, which is normally you cannot withdraw until retirement, and also give you free money. Well, actually not free lah, since if you pay tax, you are a taxpayer, then you say that's what you think, right? It's my money because it's my tax money anyway. But hey, come on. A fair comment is government not only generate revenue from people by imposing tax, right? They also have petroleum revenue from Petronas, and then business tax revenue and all that. But the irony of this, since you expect that you could have suffered a pay cut going forward, or you could be retrenched as well, which means that you don't have salary being paid, right? Naturally, you might want to actually keep that money for rainy days. So what the government don't tell you is this, that if they give you money, you're supposed to actually spend it to get the economic engine up and running again. By the way, don't forget this, if business cannot survive 3 to 6 months, then you got this money also no use, because if business closed down, you have nothing to buy, right? And then you know that if your company actually closed down, gulung tikar, you think you're going to spend the money carelessly or not, and then there's not much really. So in my opinion, a nice try on the government side to create or inject more money into the financial system, into the hands of the consumer or most people. But then if that money does not exchange hands, then economic engine will fail to restart. Just like when you want to start your car one day and then you realize your car battery is gone. And then the central bank also play a very important role in this, because they say that, it reduced interest rate, right? And then they say because of this, it's cheaper to actually borrow money. Why people want to borrow money? Hopefully they borrow this money and then they generate more money out of the money they borrow, right? It's very bad if you borrow money to buy things like TV, cars, which does not generate any economic value, because that is just for consumption. So again, when you have money, that money is used to actually generate more money, and that is where the economic engine will start running again, instead of buying stuff for consumption. Although you can nobody say you cannot. But what they really want, what the government really want, is that you borrow the money, business borrow the money, so that you stay in business and then you ultimately grow. Because let's put it this way, I ask you when they say they reduce the interest rate, back in 2 times already in early 2020. So I ask you, your credit card interest rate 18% per year or 50% per year got reduced, man? No, right? It's fixed. The one interest rate that get reduced are business loans and house loan. When the central bank say we are going to decrease the interest rate. So that the central bank like Bank Negara, they also in a dilemma, because they cannot really relax. They got to get the money to the system. They cannot just give it to everyone like free money, right? And they cannot really so-called make the lending rules less strict, make it more relaxed. They can only say that they're going to lower down the SRR statutory reserve requirement of banks, which leads to more money or more liquidity into the financial system, therefore enabling bank to lend more money, and so banks have less of your emergency buffer. But central bank cannot go to the extent to say that, hey, some of the business want to bankrupt already. Hey, bank, you also go and lend money to them. Cannot. Remember in 2008, a lot of banks in the US get screwed, right? And then ultimately, it causes the economic, to go down. Now that's like double whammy. Nobody want that to happen. Any country also don't want that to happen now. So in my opinion, central bank move of reducing interest rate is very noble. But any solution from the central bank or the Fed or whatnot that is aimed at boosting the financial system liquidity, the amount of money in the financial system, which by the way is the only thing they can do, we cannot blame them. But this would not be able to get those business who are suffering out of the predicament that they are in. So with that said, I hope now you understand why and how economic crisis happened in 2008 and 2020. These are like two altogether different beasts, although on the surface it looks the same, it feels the same. Anyway, you can call them an economic crisis, but really economic crises are just economic contractions that are normal and healthy things for an economy. It's where you actually cut off or cull the dead weight. The business that do not add value will naturally dies down, and then whatever is left are businesses that are actually creating value for the society. All those parasite business will die. It's a time to separate the wheat from the chaff. Or as Warren Buffett puts it, only when the tide goes down, you discover who has been swimming naked. So what you can do from an investor perspective, you want to ask these 2 questions. Before you invest, the first question is, does this business or company still has a product or services which people will still continue to buy and pay money for in the same way or frequency during and after the economic crisis ends? For example, this pandemic forced us to work remotely, to learn remotely. can the way we work and learn forever change? Then the next question is, why do we still need so many office or event space, right? See where I'm going from here? And the second question you want to ask is, does this company or business able to weather through this economic crisis and emerge as the survivor, or perhaps the sole survivor? Because some businesses may still possess the demand for its product and services. If some of those businesses are not able to weather through this crisis, if these businesses go bankrupt before this crisis ends, these businesses are already nowhere to be seen. They are gone forever. It's like you would not live to see the day, even though that day of liberation will eventually come, but you wouldn't be alive to see it. So in these times, I think whatever we have learned when it comes to fundamental and technical analysis, you can throw that out the window. So you only ponder over these two questions I just shared with you. For example, let me ask you, if business are facing financial problem, what is the first thing they will do to try to solve that problem? Well, the answer is, yeah, probably the business owner, if they are good, they will try to sell some of the assets or whatnot to stay in business and still keep everyone at the job. But in most cases, it would be easier to just lay off people, retrench people, pay cut. In this situation, what are the last thing to go for a business that is suffering financially? The business premise, the buildings or the commercial real estate property that they are using to run their business. Because businesses nowadays don't usually own the buildings that they're operating from, right? They rent it from a landlord. So who is actually renting this building to all these businesses? Landlord. So even if you are not an owner or landlord of all those commercial real estate property, you can look at it the other way and then what are the entity, organization or the funds that are actually renting out this commercial property to all these businesses? That is where you want to park or invest your money into all those businesses where their core business are renting out their business premises to other business. I know that sounds a bit confusing, but I hope you get what I mean. But if you don't, you get confused, just leave a comments below. Yes, so as you know that the answer is real estate investment trust, one of the things. So there you go. Seems like the only person who actually anticipated this health come financial crisis is Bill Gates back in the year 2015, who has been hawking so much about how unprepared we are about this pandemic. And fast forward to 2020, this is the coronavirus is what happens. Now there could be a miracle vaccine discovered next month, or suddenly this coronavirus become less lethal, or the virus may just really mutate and eventually change how we work and learn and live our life forever. You do not want to do one night stand from now, because one night stand or casual sex now can kill you, not through HIV, AIDS or sexually transmitted diseases. It can kill you through coronavirus. But if you look at history, the biggest and the most necessary changes typically come in the wake of a crisis. Much like our personal transformation often come in the wake of traumas. There's always growth in pain, whether you agree with that or not. Now lastly, this is a very good chart summarizing the speed, the depth, and the global reach of this coronavirus has on various other sector of business around the world. Now, if you're really thinking of investing, this is very important. Don't invest before you spend some time to glance through this, because you really need to know what the sector you're investing in. You do not want to invest into a sector that will forever be changed in a bad way by this coronavirus. Now, of course, if you are a business owner, this chart is also very important to see how this affects your business going forward from here in short term and long term. So if you really want to get your hands on this chart is not by me, but I could actually send you the link to this chart. Leave a comments below and I will reply to you. Reply with I want it below the comment section and I will send it your way. Also hit like on this lesson while you're at it.